All right, so we're going to jump in here to module three. This is a bit longer, what we're going to go through. We're going to cover derivative securities. So that's just going to take us a little bit of time. So I'll let you read over this, but basically, to start with, we're going to have options. And the options we're going to focus on are calls and puts, but we're going to talk about combining these options as well to make these option combinations, which will give us the payout that we're looking for. And we're going to conclude with a little bit of discussion on how we value these. We're not going to be calculating these values necessarily, but I want you to understand where they're coming from so that you understand how this fits within a portfolio. So the two main options we're going to focus on are calls and puts. And so the person that owns the option, the person that buys the option, is the person that can choose to exercise or not exercise. Okay. So a call option is the right to go and buy at a particular price. A put option is a right to sell at a particular price. Now, if I have a call option, the person that wrote the call option for me is obligated if I want to exercise. So they receive the money up front, but as part of that money, there's also this contractual obligation where if I want to buy or sell, depending on the type of option, they have to affect the other side of that transaction, even though it will cost them money, right? Because I'm only going to exercise if it's in my benefit, not in their benefit, right? But they got their money up front for that option. Understand that we talk about the exercise price or the strike price. That is different than the market price, which is where it's currently selling, right? So if I have the right to buy it for $30 and it is currently selling for $35, right? So I can buy it at 30, it's currently selling at 35. It already has $5 of value, right? And that's why we call it in the money, right? Because it will already generate money for you. If you've ever heard the old song "We're in the Money," might see it on a Bugs Bunny cartoon or something, but that's what this is coming from. We're in the money means our holdings have intrinsic value, not just this potential time value. Out of the money means it is not currently worth anything, right? That not to mean that it will be free, all right? You'll still have to pay for it because there's the possibility that this thing will go into the money before the maturity of it. Okay. And if it happens to be exactly the same, then it's at the money. Obviously, the strike price for an option are going to be set at particular prices, but the market price will float to wherever it should be. So when we're looking at the profit and loss on a call option, right? The exercise price is 105, and then we would have to pay $1.45 for this, right? It's going to expire there, right? If it stays below 105, I have the right to buy it at 105. If it stays below it, then I don't exercise. If it goes above it, then I will make some money, right? So if it goes to 106, then it would be the 106 minus the 105 that I have to pay for it. So I get $1. However, I paid $1.45 and I make $1, so I'm losing 45 cents, right? So for me to actually make a profit, 106 isn't enough. It actually has to be 106.45, right? And this is important because you can look like it's got this profit, but then when you include the cost of your position, because you bought the options, it can cause it to be lower. American and European options, and there's some other ones we call about like Bermuda options and things like that. But the easy way to remember this, especially if you're an American, is American options are just like European options, just with more freedom, right? And so with an American option, you can exercise at any time up to the expiration date. And the European option, it is at that expiration date. So we don't care one day before what the prices look like, but the day that it gets exercised, that's the day that we're going to see any gain, right? Whereas an American option, you could choose to get out of that option before the expiration date. Options don't have to be on stocks, right? You can get them based on indexes or futures, foreign currency and foreign exchange. So all of these other options exist as well, but they're still going to be referred to, the same way, right? And so if you hold the call, you're the person that bought the call, right? If the strike price is less than our exercise price, then it's not worth anything, right? I wouldn't bother exercising it. If the strike price is greater than the current market price, sorry, the market price, right, is greater than my strike price. Sorry, the exercise price. If that is some positive number, then that's what my payoff is. But understand that there still would be the cost of this call that we have to incorporate. But that's what the value looks like. So if you can imagine, right, it stays at 0 and then it goes up at this rate, right? So it's a piecewise function. The other side, the call writer, they can only lose money, right? Because if it were down here, the other side's not going to exercise, so I get 0. And then as this thing goes into the money, I'm losing however much money. So my losses as the writer is equal to their gains as the holder, right? That's the relationship here, okay? So, but I did get the money up front for selling the call, right? So if you look right here, this right here is the payoff of the option. So like I said, it will stay at 0 until it reaches that price, wherever the exercise is, and then it goes up based on that. However, I had to pay for that option up front. And so my actual payout will look like this. And so there's some greater value that it needs to go for this to start being worth money to me. Okay. So there's a really good chance that I lose money, right? All of this is me losing money. And then all of this is me gaining money, right? Once I cross over that point. For the other side, the person that, wrote this call, it stays at 0 and it can only go bad. However, they sold it to begin with, right? And so if the stock price stays low, they're keeping all of this money, right? So the idea is, as a writer, you could take advantage, right, of this to generate some income. Okay, puts go the other way, right? You notice it's X minus ST. That's because a put is the right to sell it. So if I can sell it, in the market for a particular, or if it's worth something in the market at a particular time, but I could sell it for some higher price, right? So it's only worth 30, but I have the right to sell it at 40. That's worth $10, right? But if I have the right to sell it at 40 and I can sell it in the market at 50, well, that's not worth anything. I could just sell it for the 50. So, and this is what that payoff looks like, but there is a maximum here, right? Because worst case, the whatever I'm invested in goes bankrupt, right? And so, but again, you notice that difference because of the price that I had to pay to get the option to begin with, right? Now, as far as the put writer, what we call a naked put means you don't own the underlying stock, right? And we used to have this. I mean, I'll let you read through it. It used to be a lot more common back in the 80s, but then we had a market correction that occurred in 87, and a lot of writers lost money because they had written all of these puts that were out of the money, right? Really deep out of the money. Prices would have to move very significantly for these to in any way pay off. And it was just an easy way to generate income because you would just write these and people would buy them just to offset some risk in their portfolio. And then once we had these significant changes, suddenly people were needing to pay all this off. A lot of market calls going on. So this is the payoff for the option. for the person that owns it. The other person, as you can imagine, they would receive money if the price is high, and then it starts to go down, and it mirrors this one, reflected around the X axis there. Okay. All right. So let's talk about protective puts, right? So we mentioned having a put as a naked put means you don't own the underlying asset. This right here is I own the asset, but I have the right to sell it if it were to go against me, right? So I don't want to have my stock go down, but in the event it goes down really far, I can sell it at a higher price, and it acts as some insurance for me, right? And so this is important because a lot of times when we're using all of these options that we have, it's not so much to generate higher returns as to minimize the risk. Right. And so the value of the stock itself is obviously ST, right? But then we would have this put that would have the difference between X and ST, where if the stock price is high, right, then we have X, or if the stock price is low, right, we still have X. And if the stock price is high, then we have the stock. Right. So it puts a floor on how low this could go. Otherwise, if ST went really, really low, we would still have ST. But in this case, we've locked in the loss that we would have. Right. So the stock itself just pays, this ST. The put has this negative down to the exercise and then 0. And then if you add these together, going up at a 45 and down at a 45 adds up to a flat line. Right. And then a flat line plus this 45 degrees makes it 45 degrees. So this is what that looks like. But then we have to remember we have to pay for the option itself. And this looks like paying for insurance. Right. So I pay for insurance. And if nothing bad happens, I'm just out what I paid for insurance. But in the event something bad happens, I've capped, that. Right. So this is the advantage of doing that. And so when you look at the stock itself there, we give up this difference here, but we're able to ensure these losses down here. So those do not continue to go. Okay. So we talked about, these protective puts. Here's a covered call. So it's the same type of thing where we have a stock position that we have, and then as well as having the call position, right? So in the event that the price is less than the exercise, then I get the payoff of the stock. If the strike is above the exercise, then they're going to call me out of the market, but I still get X, right? So what this will do is put a cap on my upside position, right? So instead of being able to gain all of these, right, I'm gonna lose that. However, if you notice, my profit, looks a lot better. That's because I wrote the call, right? So they're going to make me sell them anything that's up here, right? Once we go past that exercise price, they're going to make me sell it, which caps off my gains, right? But even when the stock goes down, I'm making money because I wrote that call to begin with. And so that gives me this additional income. So my losses can be much greater before I'm actually showing a loss of profit, right? So we can use calls or puts, right? We can write them, we can buy them. What we're trying to do is combine these to give us the payout structure we're looking for, right? So this is just using stock and either a call or a put based on that stock, but it doesn't have to just be one option, right? So this is an example, what we call a straddle. And if you think about what we're doing with a straddle is you're putting something on the low side and something on the high side, right? And so that's what we're doing is we're straddling what our current price is, right? And so this would be you have a call and a put on the same strike price and the same expiration date, right? So they're the same positions on the, or not the same positions, but they're all on the same date and same price. But one's a call and one's a put, right? And so basically I'm saying I want the stock price to go up or I want the stock price to go down. I don't want it to stay the same. Right. And strips and straps are going to be a little bit different. Basically, we're changing some angle stuff, but these are all going to be straddle. So let's look at what that looks like. Okay. So the call, right, is going to expire, right? Right here, if the strike price, the exercise price is greater than what our price is in the market, right? So if that is true, the call is worthless, right? But the put, I'm going to get the difference between X and the stock price, right? And I know X is greater than the stock price, so this is some positive value, right? If it were to go the other way, the put is worthless, right? But my call is now ST minus X. So if I add those together, I get the current price minus that exercise, which I know is positive because this only occurs when this is greater than that one. So what we end up with is it pays me this on one side, it pays me this on the other side, but I also had to pay for both a call and a put, right? So looking at what this looks like, if I have this one, which doesn't pay until it reaches some point, and then I get this payoff, but of course I have to pay for the contract. And then my put, right, it's zero until it falls to some point and then it begins to pay off. But again, I also have to pay for that put contract, right? And so when I add these together, right, if you notice the blue lines here, right, I add those together and I get this V, right? But I have to pay for both puts. And so that my V is shifted down by the addition of those two prices. So what this means is I needed the stock price to be volatile enough that it moves away from this price. But I don't care if it goes up or down, right? When I was just using a call or just using a put, I was trying to say, let's push, I want it to go up or I want it to go down. In this one, I'm just saying I don't want it to stay the same. It can go up or down, right? And then this straddle could also be written the other way with the V pointing down if I wanted to write those two instead of purchasing them, in which case my V is a little bit above and I'm gambling on it staying really close to this price and there not being much volatility. Okay. So that is a straddle. You're using a call and a put. Okay. Spreads can be like two call options or two put options on the same stock, right? And so one will be at a lower price and then one's going to be at a higher price. Okay. Bull spreads are where the stock price itself, when it goes up, we would expect our payoff to go up, or maybe it'll stay the same. But as a general rule, you do bull spreads when you think, okay, there's going to be a change in these option prices. Let me lock in some of these prices now, right? And then there's also bear spreads as well. So let's look at the payout. That'll probably make this make a bit more sense. So we have two different strike prices. We have X1 and X2, right? Because remember, I'm buying two different calls at two different strike prices, right? So if it's below both of them, right, then it's worthless, right? And then if it's the first one, right, the first one is in the money and the second one's out of the money, right, then what I get is I get to exercise mine and get the difference between what the current market price is and the call that I purchased, right? And that's my payout for that one, right? My payout, if it's above the second one, I still get that one that I own, but I also write a call for this second stock price, right? Which is going to cap where my gains will end up being, right? And so I end up getting either X2 minus X1, right? Which these are both the like $40 and $35. So I'll lock in this $5 profit or $5 payout, right? On those. And then this would be whatever it is up until it reaches that strike price, the difference, until it reaches up to X2, right? So this is going to be something less than X2 minus X1 because it falls between those two, right? And that's what my payout structure looks like. So if we graph this out, this is the first call with X1. That's the one that I bought, right? And then the one that I wrote or sold, right, is on X2. So I'm going to receive some money. This one I have to pay some money, right? And then what ends up happening is if it's really low, right, then I'm out the difference in those, right? And then as it goes up, it hits profitability, right? But then once I have to have my second one exercised, it locks in what my profit would be. Right. So this is just another way of combining a couple of positions. They're both calls, but I bought one and wrote one. This is a collar, right? So this one's a little bit different, but it's you're trying to put a position around your portfolio, kind of like how I had X1 and X2, but we're trying to keep our collar or within those, right? So we're going to talk a little bit about put call parity. And so if this does not hold, then what we're saying is there's an opportunity because there's a mispricing in the market, right? And so what exactly is the put call parity? It'll help if you see the equation, right? So this is the market value of the call and the market value of the put, right? And then we know that we're trying to exercise the call at some exercise price, right? But that exercise price is in the future, so we have to discount that back to the present day, right? Because it's some t times in the future, and this is 1 plus the risk-free rate because that's our opportunity cost, right? So we discount this back to present day, and the cost of a call plus the present value of that strike must be equal to the current market price of the underlying plus the cost of a put at that strike price. All right, now there's a lot of math to prove this, but this, if you just hold that this will be true, then what you're doing is you're looking for arbitrage opportunities because of some sort of mispricing. This is to show an example, so feel free to pause this and look over, make sure you understand what's going on. But you would see they would, they have no risk at all in this position, but they're able to generate this cash flow, right? Because of that mispricing in the market. Okay. We've talked about having hybrid securities before, things like preferred stock and things like that. Warrants are a little bit different because it's like an option embedded in there for you to buy more stock, for instance. Callable bonds, convertible securities. These are all things that are they could be exchanged for something else, right? And so it looks more like an option that you could choose to exercise at some point. And financial engineering is really what this is getting into. So if you think about what engineers do, they're studying material strength, how they behave under certain types of stress. A lot of the math that we do within the upper level finance is a lot of the same type of engineering. It just has a different application, of course, right? But I've worked with a lot of people that had aerospace engineering degrees, but they got paid better on Wall Street. So that's what they ended up doing instead, was building those types of models. So that's what we're doing, and options are a good way for us to get the payout structures we're looking for, right? Because what we're trying to do is to fit our needs for income, right? This is where all of our cool financial engineering comes in. And so we build out what's going to have the payout structure we're looking for the lowest possible cost. Okay. These are a bunch of other options. I just want to make you familiar with these. It's basically a way for to create something that doesn't already exist in the market, right? A lot of times what we're doing is repackaging risk or repackaging cash flows and then selling those to investors. And so these are some other ones. If you want to look through the text, you can see a lot more detail on these options, but basically it's just trying to align interests of investors with the firms. Okay, so now we're going to talk about how exactly we have the value for these. And there's two components to the value of the option. One is the intrinsic value, right, which is how much it is in the money, right? So if its current market price is 38 and I can buy it for 40, then it's not really worth a lot because I could buy it for 38 without the option, right? And so that would be equal to zero, right? The intrinsic value. But if the market price is 38 and I can buy it for 35, then it's got $3 of intrinsic value, right? Now it will sell for more than that because that $3 is the floor. Even if it's equal to zero, the intrinsic value is equal to zero, the value of the option will be greater because you also have the time value, right? It's not the present value. It's not that, oh, it's going to be this in the future and therefore it's worth this much today. The time value, we're going to look at it near the end of this module, but it's like, what's the probability that the stock price will be in the money when we exercise, right? And so that's where this time value is coming from. It's a probabilistic thing. Okay. And so this right here is what the call option looks like as we get closer and closer, right? And you can kind of think of this thing as getting stretched closer and closer, and actually add exercises where it like develops that little bend, the kink. And from a physics or calculus standpoint, it becomes a discontinuity at the point of exercise, at that moment. But before that, it takes on this type of value. And when we're looking at the change in option prices, basically this shape will change as time goes on because it's getting closer and closer to snapping to the position of being at that angle, right? These are all the things that go into to your stock or your option price, right? So if the stock price is going up, then the call options will go up. If the exercise price goes up, so there's going to be less wiggle room between those, then the value of the option goes down, right? If there's more volatility, there's more time value, so that makes it go up. The more time we have, the more time value. The higher my interest rate, the higher the value, and that's because you remember that put call parity or call put parity. Remember, we use the risk-free rate. So as that increases, more value must be on the call option than in being on the present value of the exercise price. And then if there's dividend payouts, that drives it down because having the option means you have to cover those dividends as well, right? So as all of those things change, this is the change in the option. So just a quick rule to follow. Okay. This right here is a restriction on how high your call value could get, right? And basically it just has to do with, the stock price is only going to go up so high because we have to account for the present value of these other issues. So when we look at this, we now have two different 45-degree lines, and the call must fall between those, right? So this is our upper bound, right, which is equal to the stock price, right? And then the lower bound is the present value of all those dividends and the present value for that exercise price, right? So this is the call the curve that we were looking at falls within this range. So here's an example of that, right? So it has to fall within these two lines. So this sort of gives you a channel of where the given the call must be within at a given moment in time. Okay. Now remember, if it's an American option, you can exercise whenever you want. If it's a European option, it's at maturity, right? And so this is just a bit more talking about exercising early and then also paying dividends, because you have the dividend itself that you have to make right with whoever is buying stock. Again, this tells you a little bit about why you would exercise early of American put. There are times when they're equal, and a lot of times we treat them as the same, but there are obviously differences because American options tend to go for more because of that flexibility, right? The more flexibility or the more option you have, the more you have to pay for that, right? And this is just to show American puts versus European puts, because the American could be exercised at any point. And so you see how the line gets shifted a bit with the American put, where the European, we're just using the present value of that strike, which is a different type of bound, which is what allows these prices to be lower relative to the American. Okay, so when we're talking about how we come up with these pricing, the two things we're going to look at is what we call binomial and then Black-Scholes. So binomial pricing, it's, think of coin flips, you know, and if I flip a heads, then it goes up, and if I flip tails, it goes down. And I'm going to flip this millions of times every day, right? And so I'm going to get slowly meandering up and down prices, right? And then we can talk about how much an up step is and how much a down step is. Those don't have to be the same, and often they're not. And so we can put those in, the U and the D. And then what we say is, okay, we're going from here to some future value. And then we would, you know, flip a coin or whatever. We're going to be an up or down. If the stock price goes up, then this is what my call option is worth. And if it goes down, it's out of the money, right? And so this is just the value of the stock. I pay back the loan. This is what I would get, right? So this would be an example of that type of pricing. Here's another example. So if I buy the share of stock at 100, so I could borrow that to buy the stock with. I pay some portion. I got to repay the loan, right? Or you know, I could have the option itself, right? And this, you'd see the final payoff is exactly 3 times what this call option was before, right? Meaning that this cash outlay must be equivalent to 3 times the cost of a particular option, right? And so what you're pricing it based on is you're saying if the stock price will go up or down. If it goes up, it goes to here. If it goes down, it goes down to here. This is my payoffs. And then, you know, use that to calculate what it should be. Okay. And then here is the hedge ratio, right? And so this is, where would the option prices be, right? Based on where this could go up or down, right? And then where would my stock prices be? And then this would help me know, am I able to offset the risk of the stock going up and down using these types of calls, right? So I'm building a hedge. When we talk about hedge funds later, that's going to be a little bit different than what we're talking about here. This is what people normally think of when they hear about like hedges, you know, some sort of protection. How much do I need to build my wall, my hedge around my property, right? Okay. So obviously, we just did that with one period, right? And I said, when we do this, we do it for lots and lots of periods, right? And so as you can imagine, as we make this go higher and higher, then we start getting, you know, all of these other multiples, right? And this becomes more and more complicated as our valuation model has more and more steps, right? So as far as our up and down measures, right? How much is that? What we normally use is this is Euler's number, E 2.71828, right? And then we're going to raise that to the power of the standard deviation right, times the square root of the change in time, right? So I know this looks a little complicated for up and down, but it helps us when we do our Black-Scholes option pricing, right? So let's just go ahead and pull that up. And I know this is a lot, so I'm going to kind of break it down. So that we're just saying, hey, the value of this call, right, is equal to whatever my current stock price is times a probability, right? And this N, it means it's going to be a normal distribution, right? So what's the probability that this normal distribution stays below some value, right? So you can think of this as the value of the stock is low enough that we don't exercise, right? And so that's what this is. What's the probability that we're in that state of the world? And this D1 is all of this, but it's just a measure of the stock price relative to the strike price, right? And then this right here is using my risk-free rate, right? Because I can just go and invest that, right? Plus the variance of the stock, right? Because it's sigma squared, right? So it's the variance of the stock divided by 2 times time, right? And then all of that is divided by the standard deviation, not the variance, right? So I take the square root of that and then the square root of time, right? And then the D2 that's over here is just D1 minus this part in the denominator. Basically, it's really like 1 minus D1. But yeah, so you there's some probability that you're in the state of the world where you're concerned about the stock price, which is this one right here, and there's some probability that what you're concerned with is the exercise price, right? And then I'm discounting that back at e to the RT, right? So it's just a continuous discount back to present. Okay, so I know there's a lot going on there, but really it's just am I concerned with the current stock price times some probability, and then the exercise price times the remaining probability, right? And so this right here would be like, what's the probability that it's, you know, stays within this world, and then the other one would be the probability that you're in another world. Okay. Some of the restrictions that we put on here, the stock pays no dividends, right? Because dividends make that formula a little more complicated because we have to account for the dividends being received and then paying them out. And interest and the variance rates are constant. We know that that's not necessarily true, but it has to do with because we're drawing from this normal distribution and things like that. And then the stock prices are continuous, so there's no extreme jumps, right? Which normally holds, but when you have like a stock close for the day and then open the next day, if there's not robust off hours trading, then you can get these discontinuities, which is really uncomfortable in calculus, right? So, but yeah, that's where that comes in. So we are measuring stock volatility, right? Now we've done this before. That's how we even got our beta, right? It was the covariance divided by the variance of the market, right? So we had to know what the variance of our stock was to get that, and as well as the covariance. So, so in our case, you know, we're doing this type of volatility measure, but we know that they change over time. So that does have this complication. Right. And so if you notice here, there's just some modifications. I have a couple of slides like that. So feel free to pause and read over that. Okay. This one is the put option. So we first talked about call, right? And here's one for put. And then if you notice, our S0 and then X e times e to the negative RT, right? They've changed their signs, and that's, you know, the nature of this put. But other than that, you notice that's very similar. And this goes back to our put call parity. So we could actually set that previous call and this put equal. It's just we have to account for the stock price and the exercise price, just as we did before. Okay. So the hedge ratio is the shares required to hedge for the price risk of an option, right? So basically what we're trying, again, we're building a hedge around my investment, right? That's what this is for. And so this tells us how well this does that. And we'll look at what that price looks like, right? So this is the call, right? Now it doesn't snap, until the actual exercise, but it'll have this bend. But at some point, we'll have this optimal hedge ratio, which is based on the probability that would be in or out of the money, right? And so it's the line here is going to be tangent to that curve at that particular exercise price. I'm going to just let you read through this one. I'm going to show you a slide where this is going to look very similar, right? But yeah, portfolio insurance, basically, I'm going to pay for an option. So I'll pay out of pocket, right? But then it protects me on the downside. Right. So this right here would be like that cost of a put, right? Which it saves me from all the downside here, right? However, there's this, I had to pay for the put. So no matter how high it goes, I still have that cost of insurance, which would be very similar to if I bought insurance for my car and had no accidents. I'm just out the cost of insurance, but I was protected for that time period. Okay. And in the previous slide, we mentioned, that this delta, and there's a whole area of what they call the Greeks in finance. And so there's, all these different ratios and these different terms. But with delta, what you're looking at is how this is the change in this tangent line, right? So that's what it's will give us. So as the stock price changes, you can imagine that line itself will pivot flatter as it goes up, and then as this goes down, it pivots to this 45-degree line is basically what it's going to get to, and then yeah. And then here's a bit talking about in 2008 and 2009, because what ended up happening is a lot of loans look like options, right? And so when we have credit default swaps, right, what's going on is these loans are out there, and whether or not they can get pushed back to us will influence the value of that credit default swap, right? Whether or not they're going to sell it. So this is, again, as we shift, right? From this is 100% of the face value of debt. So as the value of debt's going down, you notice that this put is asymptotically going to that 45-degree line. That's what it's saying is, those debts will get refinanced and that type of thing. And then these debts are more likely, or these right here, they're able to refinance as needed. As their firm value is less than the value of debt, then the probability of a default increases, right? And so you're starting to see it look that way. And then elasticity itself changes. You probably studied elasticity in microeconomics, right? We talk about substitutability. And so the call option itself becomes more and more elastic as the stock price falls, right? Okay, so here's a bit on options and delta, and then we're going to look at an example here, right? So when we're calculating delta, it's the change in the option divided by the change in the stock. So it's how quickly it changes. It's kind of funny because that's a capital delta for each of those. That just means change. And so that's what delta is. The sensitivity of delta is called the gamma. Again, like I said, there's a whole family of these. Those of you that have taken calculus, this is like a first derivative and then a second derivative, but they're partial derivatives along different axes, right? So So that's what's going on with gamma. And an option gamma is like the bond convexity. So we had duration and convexity when we were looking at our bonds. When we're looking at our options, we have delta and gamma, right? But they play those two types of roles, looking at the slope and then looking at how that slope changes. Okay. All right. And then delta neutral is a sort of a special case. I'll let you read about that. So what's going on with Black-Scholes? Well, when initially it came out, it worked really well. And then over time, we've seen periods where it doesn't work as well, right? And so it tends to be fairly close, as long as the markets are behaving fairly normally. But as you saw, a lot of that value is based on what's the probability that we're in the money or out of the money, right? And because of those changes in probability, that impacts this pricing model, right? And so we're not sure exactly. In the book, they suggest that maybe, people act like there could be a market crash, right? And if people act like it's true, that may as well be true, right? I'm not sure exactly what drives this mispricing as that volatility goes up, but that's definitely a plausible explanation. All right, and that'll be it for these types of options, but we're going to continue on in our next module, looking further into those.